Are you a managing authority of a European structural and investment fund program that is interested in using financial instruments to fund projects in your region or country? In this video, we are going to explain which financial products could be used to best meet the investment needs identified in your program. The most suitable financial product or products should be identified in the ex-ante assessment. There are several criteria which may influence the range of possible products. Generally, the type of financial product will result from the assessment of market needs and the identified gap in the market. Moreover, the type of final recipients you want to reach, the type of project to be invested in, and the financial context in your region or country will also need to be considered. For example, there is a difference between having a venture capital instrument that is designed to assist a relatively small number of high-growth companies and a microfinance scheme that provides many microloans to disadvantaged groups. These two examples of financial instruments are very different products, suitable for different types of projects and different contexts. There are four main types of financial products: loans, guarantees, equity, quasi-equity. So, let's look at the first product type, loans. A loan is an agreement which obliges the lender to make available to the borrower an agreed sum of money for an agreed period, for an agreed cost, under which the borrower is obliged to repay that amount within the agreed time. Usually, companies and individuals can receive commercial loans from a bank. However, there are some final recipients who are not able to obtain sufficient or affordable financing. And this is where your financial instrument can help. Through financial instruments, final recipients can receive a loan with the advantage that the interest rate may be lower, the repayment periods could be longer, and the requirements may be more lenient in regards to the credit history or collateral. For example, loans could be provided to minorities and marginalized communities to support self-employment and the creation of small businesses, which would then encourage active inclusion. For example, a young entrepreneur like Katerina. She wants to renovate an old factory and turn it into a culture center. To be able to start her business, she needs a loan, but the normal bank interest rate and repayment periods makes the project difficult to finance. Luckily, there's help available. With an ESIF financial instrument, Katerina can obtain a loan that reduces the interest rate. This makes her monthly repayments affordable, so that she can finally realize her dream project and set up her business. And her local bank is also happy about the ESIF intervention, because it helps them support other small and medium-sized businesses that want to invest in new projects. The second product type are guarantees. A guarantee is a written commitment to assume responsibility for all or part of a third party's obligation if an event occurs that prevents this third party from fulfilling its obligation, for example, when a loan is not paid back. This means that the financial instrument does not actually provide the loan to the final recipient, but instead it gives a guarantee to a commercial lender, like a bank, which pays out the loan to the final recipient. The guarantee can therefore either help make these bank loans happen or decrease the cost for the final recipients. If the loan has been paid off, the funding that was set aside for a guarantee can be released and reused to guarantee another loan. This way, the guarantee fund can revolve like other financial instruments. For example, let's take a rural region where the farmers may have had difficulties obtaining a loan due to a lack of credit history, or because their assets, such as their livestock or land, are not accepted by the banks as collateral. Here, the managing authority could decide to use Rural Development Programme funding to set up a guarantee fund, which helps provide guarantees to the banks that reduce the risk of their loans to farmers. This way, the Rural Development Programme funding would make it possible for farmers to receive financing, either under better conditions or to receive it at all. Equity can be another useful type of financial product. Equity means the provision of capital to a firm which is invested directly or indirectly in return for a total or partial ownership. The equity providers typically assume some management control of the firm and share the firm's profits, but also its losses. They can be closely involved in the management of the company by providing additional expertise, or they can share their network to accelerate its growth. Equity instruments, therefore, differ from debt instruments because of this ownership factor. Let's take the case of a region that wants to encourage economic development and employment. It could use an equity fund as part of the region's growth strategy to support entrepreneurs. For example, Alex is a young entrepreneur with an idea for a new smartphone app. He could use the investment from an equity instrument to set up his business and develop the app to a stage where it can become a commercial product. Equity instruments like this one have the potential to boost the number of business startups in a region and trigger contributions from private investors to the region's development. The final category is quasi-equity. Quasi-equity is a type of financing that ranks between debt and equity according to the exposure to loss in the event of insolvency or the level of ownership acquired. An example of this instrument could be a subordinated loan that is used to co-finance an urban development project seen as too risky by other lenders. A subordinated loan would normally only be paid back once all the other lenders have been repaid. These types of financial instruments therefore provide a higher expected yield than standard loans because they are riskier. So, let's briefly compare the 4 types of financial products. Loans are very common products. They're popular due to their relatively low risk and the traditionally important role of this type of financing in continental Europe. A financial instrument that gives out loans usually addresses a high number of recipients, is relatively easy to manage and, because of a predefined repayment schedule, it is easier to reinvest the returned money in further projects. A financial instrument that provides guarantees should require less funding from a managing authority to achieve the same financing effect for the final recipients, due to the multiplier effects of guarantees, since guarantees represent only a risk reserve for the loans given by a commercial lender. Financial instruments that offer equity can be helpful in order to stimulate investment by the local private industry or external investors in riskier areas, often associated with the early development stages of a company. In terms of returns, the investments may generate high profits, but also significant losses. Because of the close involvement, which is time-consuming and cost-intensive, such financial instruments typically target a smaller number of final recipients, but with a higher investment volume. The success of financial instruments that offer equity can depend on whether the target market has previous experience with equity, and whether there are professional equity fund managers and other investors that are already active. And finally, there is quasi-equity, which is a financial instrument that has characteristics of both loans and equity. Such financial instruments may be more lenient in regards to collateral and can stimulate investment in riskier areas. To help managing authorities make more use of financial instruments, the European Commission has developed 5 specific products with standard terms and conditions. These are the so-called off-the-shelf instruments that consist of 3 loans, 1 guarantee and 1 equity. One example of these off-the-shelf instruments is a so-called renovation loan, which has been developed for promoting investments in energy-efficient housing stock. It combines loans and technical support, and it is based on the experience from several countries that used similar instruments during the previous programming period. The standard terms and conditions for this off-the-shelf instrument, and for other ones, can be downloaded from the European Commission's website. The other off-the-shelf financial instruments cover 3 products for small and medium-sized enterprises: risk-sharing loans, capped guarantees, and co-investment facility, as well as a product for urban development. So, which financial product or products are right for you? For more detailed information, please refer to the advisory material, which includes case studies and videos available on the FI Compass website, www.fi-compass.eu.